Hi, I'm your AFM expert tutor, Andrew Mower. Welcome to this debrief of the question Melplash. Now, if you haven't yet attempted this question, make sure you do so. It's available in ACCA's practice platform. Once you've attempted it, you can watch me work my way through it. 25 marks of content in here, which is great. Now, this is a valuation question and a business acquisition. It's got a lot of discussion parts in, so look at how I lay those out and how I structure those. And the calculations, one of those questions that the examiner often says students struggle with because there isn't necessarily a set pro forma. You have to react to the data you've been given in the scenario and come up with some suggestions. So in a question like this, just relax, look at the data you're given and see how you can use that to best come up with some answers. And do that and you'll be fine. So enjoy this video. So in Melplash, which is 25 marks, we've got cash bids and share-for-share exchanges. We need to consider the impact on earnings per share, EPS, and their gearing. There's then quite a lot of discussion. So we've got acquisition discussion, and then we also need to discuss the regulation and governance of takeovers. Now in a 25 mark question, remember that's going to be 49 minutes if you times it by 1.95 minutes per mark. And you're going to spend the first 9 minutes planning and reading. So read the requirements, plan out your answer with all your headings and subheadings, get it all laid out nicely, and then we're going to read the exhibits. And then the remaining 40 minutes, we're going to write up our answers, do the calculations in the spreadsheet. Remember, that's 2 minutes per mark, and you've got to be very strict with yourself, especially in a question like this one, Melplash, with those calculations. There are only 9 marks for the calculations. The rest of this question is discursive. So don't spend too long doing the calculations. Don't get lost in them. And then 45 minutes later, realize you haven't written any words. You need to be very strict with yourself. If you get a bit stuck, make up some numbers, keep going, just keep swimming, as I always tell my students, just keep going, and you'll be able to then discuss them and pick up loads of marks. So here's the question in the exam software. Very first thing we should do is open up the requirements and see what they want us to do. So have a read through those. And as you can see, we've got calculate for the 2 scenarios. The funding required, impact on earnings per share, and impact on gearing of this acquisition. Part B, if the acquisition was to take place, discuss the concerns that Melplash's shareholders may have about those 3 things there. So this is a discussion part. And then part C, discuss the regulatory and governance concerns relating to the promises required by Peter and Patrick Tullum. Now in this one, we've got professional marks. So we've got analysis and evaluation, skepticism, and commercial acumen. So lots of discussion in this question, only 9 marks of calculations, and then we've got 16 marks in total, including those professional marks that are going to be for the more discursive parts. So very important that you know how to do that in this exam. It can happen. We get more words than we do numbers. So it's really important you know how to answer a question like this. Of course, we'll start with part A. So we'll do the calculations to begin with, and then we can then comment on those essentially in parts B and C. So let's have a look at the first exhibit. So this is all the background stuff, tells us a little bit around the company and what they do. So they're a bus operator, but they're looking at getting into trains. So have a read through all of that. It gives you a little bit of their structure and then a bit of the reaction to the acquisition as well, which will be useful for the discussion parts. Then we have the bit we're going to need for the calculations in A. So we've got all the financial information of both companies, Melplash and Highmore. Interesting in this one, they give us gearing, for example, and they give us earnings per share, PE ratios and things. So they're giving us a lot of information here. This is one of those questions where you've just got to try and deal with what you've been given and understand what they've given you. I think, okay, how am I going to use that? And quite nicely, they've given us industry average gearing of 34%. So if they give you that, we're going to need to comment on that at some point. And then the bid, offer, and acceptance, we'll also need this for the calculation parts, so how they're planning on making the bid. But before we get into answering a question, it's always good to get your answers set up for the whole question. So for part A, that's all calculation based, so we're going to do that in the spreadsheet. So I said please see the appendix. Then for part B, if the acquisition was to take place, discuss the concerns the shareholders may have about those 3 things. So I called that shareholder concerns, and then I've done subheadings for each of the 3 things: earnings per share, gearing, and then control. So I'm getting that structure in place. Just remember that's only 7 marks, so 14 minutes. We haven't got too long to do that bit. And then part C, regulatory and governance concerns. Again, I've split that into regulatory and governance. So I do all that before I get going with the question. Again, this is one of those where it's very easy to get sucked into the calculations and then forget to do the rest. So just be very strict with yourself. That's why I put the timings in as well. So you're going to give yourself 18 minutes to do part A, and then you're going to move on after that. So let's get into part A. And in this requirement, they wanted us to work out the funding required for the acquisition, the impact on Melplash's earnings per share, and the impact on Melplash's gearing. So 3 things to do. Not really a set pro forma to do for this. We've got to react to the information they've given us. So let's have a quick look at the bid offer and what's going on here. This is in Exhibit 3, so you need to read all the exhibits, of course. So they're looking at either doing a share-for-share exchange, so 2 shares in Melplash for 3 in Piemore, or a cash offer of $2.75 for each Piemore share. So when the requirement says under each of the 2 choices, that's what we're looking at. It's either a share-for-share exchange or a cash offer. Then it gives us some more information, gives us some post-tax synergy of 8 million in there. So that's something we need to consider. It then tells us the company's combined PE ratio is going to be the same as Melplash Co.'s before the acquisition. Now, the fact they've told us that is a real clue. So you're thinking, I'm going to need to use that at some point, aren't you? If they have told us that, we're going to need to use their PE ratio when we're looking to value something. It then tells us about the cash payments. And it says that we will fund this firstly using the balance of cash and cash equivalents, which is $102 million. And then it says, assume the return on the surpluses is 6% pre-tax. And then the balance of the cash requirements for the cash payments for shares will be funded by debt. A pre-tax cost of 9%. So we're going to have to take on some debt to finance the rest of that. It then gives us a couple of extra bits. So assuming that the existing debt will be taken on and not paid off. So that's one thing we need to look out for. And they'll keep the cash and cash equivalent within Piemore. It then says we've got tax at 25% as well. So lots of information going on. So that's the premise. And we're going to have to do some calculations based on those. Again, lots of instinct in this one. Lots of thinking, right, what makes sense? We need to work out the funding required and then impact on earnings per share, etc. We need to use all of this Exhibit 2 information as well. So they're giving us Melplash and Piemore's information in there. So we're going to need to use quite a lot of that. And it gives us their current earnings per share and their current gearing, which is great. When we're calculating gearing, by the way, have a look in there. It tells us how they've done it there. So we will just replicate that way. Do you remember there are 2 ways of doing gearing? You can either do debt over equity or debt over debt plus equity. Well, this one is the second one. It's long-term liabilities. So debt over long-term liabilities plus equity. And it's by market values. So when we're calculating gearing, we need to make sure we're doing the same approach because then we can compare it to their current situation. And as we said earlier, they've got the industry average, which will be great for our discussion points later. So let's get into the calculations. And we'll begin by looking at the funding required. So that was the first thing they asked for. So let's do that first. Now I'm going to split this into 2 parts. We're going to think about if they do the cash offer or if they do the share-for-share exchange. So we'll begin with the cash offer. Now, the key information in here is the fact that we'd be looking to buy Piemore for $2.75 per share. So that's the information they give us in this exhibit. So that's how much we'd have to pay. So the value of Piemore, so the cash offer we'd have to make would be $2.75 times by the number of shares in Piemore. And if we look in the other exhibit, in Exhibit 2, it tells us that Piemore have got 150 million shares. So that's all we're going to need to do is just say 150 million times by the price of 275. So I'm going to do 150 times by 275, and that will give us our amount we're going to offer. So 412.5 million, so 412.5 million. Great stuff. Now, do you remember it said that we're going to finance that using cash and cash equivalents? So the cash available, it told us in the question that we've got 102 million of cash and cash equivalents available. So it told us that there. I'll just remind you where that was. There you go. So cash payments will firstly be made by the balances of cash and cash equivalents held by them of 102 million. And therefore, the funding required, the actual amount we're going to need to borrow, is just going to be the difference between those, isn't it? So the actual amount we're going to need is just going to be the 412.5 less that 102 million, which comes out as 310.5 million. So that is our first amount that we'd need if we were doing a cash offer. That's the amount we'd need to borrow. And that's our answer for the first part. Now that was a mark, which I thought was quite nice. But you just wait for this one. The share offer, we wouldn't actually need any more funding if we did a share offer, would we? You don't have to pay anything. It's just offering them 2 shares in Melplash for every 3 in Pymore. So there's no transfer of cash. So we wouldn't actually require any funding. So you just see here, no funding required, or no extra funding required, we could say. Now, if you said that here, that also got you 1 mark. So being aware that if you're doing a share for share exchange, we don't actually need to pay anything else. That got you a mark, which I thought was really kind. So that's a nice 2 marks to get us started. Now, in these calculations, it relies on you being able to piece together various different formulae and knowing how and when you need to use them. So just a couple of reminders. Earnings per share is just earnings divided by the number of shares. Now, when we talk about earnings, that's profit after tax. Now, technically, you should then deduct any preference dividends, but there aren't any in this question, and in AFM, they're quite rare. So just treat earnings as profit after tax in this question. When we're valuing their equity, we're also going to use this valuation method. So the value of a company's equity is their earnings times by a suitable PE ratio. Now remember, that is quite approximate, so there is definitely some discussion there, a bit of skepticism around that whole method. And assuming that the earnings are normal, also assuming that P ratio is going to be sensible. But they are 2 formulae that will be really useful when we're doing these calculations. So now we know what we're dealing with, let's think about the impact on earnings per share. And again, I'm going to split this out into the cash offer and also the share offer. So make it really clear to the markers which one we're dealing with. So what we need to do now is work our way through and think, what is the impact on Melplash's earnings per share if they go ahead and make this cash offer? So we'll start with their existing profit after tax. And we can see that is there, 60 million at the bottom. So 60 million is where we're going to start. That's their existing profit after tax on their own as things stand. Remember, we can use that as earnings. That's absolutely fine. So let's just get that in. So the Melplash existing profit after tax. We're going to do everything in millions. It's always good just to label that so it's really clear to the markers what we're doing. So we're going to put in 60 there. Great. Then what will also happen is if we acquire Pymore, we're also going to obtain their profit after tax. So that 33 is also what we'd expect to get now as well. So we can include that in there as well. Then also we're going to generate some synergy. Do you remember it told us in the other exhibit? Annual post-tax synergies from the merger are expected to be $8 million. Now, if they were pre-tax, we would need to tax them, but they're already post-tax. So thank you very much. That's great. So we can include that. So synergy, we're going to include as 8 million in there as well. So this is all looking good so far. If we combine with Pymore, we're going to earn their profit after tax and we're going to generate some synergy as well. But what we've got to think about is the impact of the financing. Remember, if we're doing this cash offer, as we worked out up here, we are going to have to use up all our cash reserves and we're going to have to finance that £310.5 million as well of extra debt. So we need to think about the impact on those on our earnings. So let's start to begin with the interest we're going to lose on that cash. Do you remember it tells us in this exhibit on the left that at the moment they're earning 6% pre-tax on that cash. We're going to miss out on that now. So we need to include that effective opportunity cost as an expense here. So we're going to miss out on 6%. So I'll make it negative. So 6% of our 102 million. But don't forget that was the pre-tax return. So we do need to make that post-tax. So we wouldn't save all of it because we would have saved a bit of tax on it. So just make that post-tax and we end up with 4.59. So that's our lost interest. But not only that, we've now got to finance this additional 310.5 million. And it says that that would be funded by debt at a pre-tax cost of 9%. So we're going to have that extra charge now. And to work that out, we're going to do again, minus that amount. And I'm just going to click up there to reference that cell. So 310.5 times by 9%. We're going to have to pay on that. But we would get tax relief on our interest payment. So we'll make that post-tax. So times by 1 minus 25% again. And if we do that, we are going to miss out on now just under $21 million. So let's add it all up, and that will give us our new total earnings. So we can do all of those combined. You can just underline that number. So I just did Control U there to underline that to show that we're doing a total. And if we just do the sum of all of those, that will give us our new total earnings, which is 75.45. And again, don't forget you can tidy that up a bit by clicking on the 2 zeros at the top there, and we could make that all to 2 decimal places just to make it look a little bit neater. Great. Right, there was a mark going for the lost interest and there was a mark going for the extra interest. So let's just give ourselves those. Now, before we start celebrating the fact that we've done this bit, we've got to be careful because we are working out the impact on earnings per share, not just total earnings. So what we now need to do is divide it by the number of shares. Now, if it's a cash offer, Melplash have got 200 million shares. That isn't going to change. They'll still have 200 million shares. So their number of shares is still going to be 200. So we can just include that in there. And therefore, our new EPS would just be the 75.45 divided by our 200 million shares. And that comes out as 0.377. And again, we'll do that to 2 decimal places. So that is our new earnings per share. And that is our answer for this section. So we can highlight that just to really point it out to the markers. There we go. And there was a mark going for that. So don't forget in AEFM, even if that number wasn't perfect, if you then divided it by the number of shares to get an answer, you'd still get that mark. So just keep going. Never give up. Just keep working through. Even if you didn't get that bit perfect, you still could pick up that mark, which was quite straightforward. Right, now we need to do the same thing for the share offer, which is probably slightly easier. Now we've done all that and we know sort of a rough structure of what we're doing. The share offer is slightly nicer. Again, we can do the same structure. And actually, the first 3 bits are going to be the same. So you can just copy and paste these because we're still going to have the same existing profit after tax. We'll have Pymor's profit after tax and we'll have the synergy. So that's not going to change at all. And then you wouldn't have any of this stuff, would you, if under the share offer? We're not having to raise that finance. We'll still keep that cash. So actually, that's it. Our total earnings are now just going to be this, which is great. So we're not having to worry about all that extra interest and lost interest. It's just going to be these 3 added together if we do the share offer. And there we go. So 101 million. And again, we can do that all to 2 decimal places just to be consistent. Lovely. Now the number of shares isn't going to be 200 anymore, is it? So the number of shares, and again, I can just copy and paste that, save a couple of seconds. Because we are now doing a share for share exchange, remember, the terms are at the top of this exhibit. It's 2 shares in Melplash for every 3 shares in Pymor. We need to work out how many shares we're going to have in the new combined company. So we'll still have Melplash's 200 million. So they're not going anywhere. And then they're going to offer 2 for 3 of Pymor's. Now, at the moment, they've got 150 million. So what you do is 2 over 3 times by that. And that will tell us how many shares we're going to issue to Pymor. So the total number of shares will be 200 in Melplash already, plus we're then doing 2 for 3. So you should do 2 over 3 times by 150 million. So that is going to be 100 million shares that we're issuing to Pymor, isn't it? We're offering them 2 for every 3. So we're going to issue them 100 million shares. And if we do that, there we go. We're now going to have 300 million shares in the business. So our earnings per share will just be 101 divided by the 300, which comes out as this number. Again, let's do it to 2 decimal places. Pop the $sign in. Give it a little highlight just to make it really stand out. And there we go. We've got our earnings per share. And again, that was a mark. And you also got a mark here for working out the number of shares under the share for share exchange. So we're picking up lots of marks along the way, which is really nice. Right, now let's think about the impact it would have on gearing under each thing. So again, I'm going to call this the cash offer. So we'll split that out. And when you're doing gearing, it's always good just to label we're going to need debt and we're going to need equity, aren't we? So we're going to need those two things. So we're going to need debt and we're going to need to know the value of equity. So the value of debt in the business if they do the cash offer. So we're going to need to use Melplash's existing long-term liabilities, which I've highlighted in green by market value there, 285 million. And then we've also got PIMORs of 225. So we take on that as well. So we combine those two. But don't forget, we're also then going to need to include the extra debt we're taking on, which we worked out at the top, didn't we? That 310.5 million of extra debt that we're going to need. So we're going to need to factor that in as well when we're doing our debt. So our debt balance is going to be the 285 plus the 225 plus that number we worked out earlier, 310.5. And that'll give us the value of debt, which is 820.5 million. Again, we can label that as million. Okay, so that's a good start for our debt. Now for our equity, how are we going to work out the value of equity in the business? Well, do you remember that little sentence I pointed out earlier that's highlighted in green? The company's PE ratio, price earnings ratio, is expected to be the same as Melplash Co.'s before the acquisition. So to value their equity, what we can do is do their earnings times by the PE ratio, and that will give us the value of their equity. So that's what we're going to do here. That was the clue that we needed to use that method, and that's what we're going to adopt. So the PE ratio is 13.2. I've just highlighted that in green. It says that it's going to be continuing at that level. So I'm going to do 13.2, and then what we can do is multiply it by their earnings. Now, do you remember the earnings from the cash offer? We worked out up here, didn't we? 75.45. So we're going to take those earnings and multiply those by our PE ratio, and that'll give us the value of their equity, which comes out as that number. And again, we can just do those to 2 decimal places. Great stuff. Okay, so 13.2 is the PE ratio times by their earnings. That will give us the value of their equity. Now that is very approximate, something to discuss, of course. That isn't necessarily going to be all that valid, but it's fine for now. So in terms of gearing, remember it tells you how to do gearing on the left there, doesn't it? We're going to do long-term liabilities, so debt over debt plus equity. So we're using that method. So the gearing is just going to be debt, that number, divided by, and then you do need a bracket, debt plus equity. There we go. So it's debt over debt plus equity, and it comes out as 45.2%. And we'll do that as a percentage. And there we go. Okay, and again, we'll make that bold, give it a little highlight. Good stuff. And that was a mark for working out their gearing. Right, now we've done that once, it was relatively straightforward to do it again. And what you could do actually is copy and paste that. So you could copy and paste this structure and do it again now, but this is for the share offer instead. So we can just change the wording, just change that to share offer. So in terms of the debt this time, we're just going to have the 285 and the 225 that we saw earlier, aren't we? So we're going to have the 285 and that 225 because we don't have that additional debt now anymore. We're just going to use those two existing figures, the long-term liabilities for both companies that we saw there on the left. And then in terms of the value of equity, we're just going to do the same thing. The PE ratio, which was 13.2, times by the earnings. Now the earnings in this one for the share offer were that 101 there, weren't they, from the previous part? So we can use that earnings figure that we worked out earlier, 101, pop that into there. And there you go, we've got 1,333.20. And because I copied and pasted that formula, it's already worked out the gearing for me. So I saved a bit of time there. 27.7% is the gearing. And there you go, that was a mark for that as well. And there we go, we've done all of our calculations. So we worked out how much extra financing or funding we'd need. We worked out the EPS, and then we've worked out the gearing as well. When you break it down like that, it seems fine, doesn't it? And a lot of you will think, oh, that wasn't too bad. The challenge with these questions is just knowing where to start. And again, the more questions you do, the more you'll see things like this and you'll practice and you'll think, oh, okay, I know what I need to do now. The main thing is just staying calm, looking at the information you've been given and think, right, what can I do with that? Why have they told me this? How could I logically work that out? And work your way through it and you'll pick up marks. As you can see, we're just picking up all these marks just for doing these little calculations. And again, even if your numbers aren't perfect, you'll still get your own figure rule marks. So just keep going through, picking up those marks, and you'll pick up loads of credit along the way. Right, on to part B, and this is the discussion part. So discuss the concerns the shareholders may have about earnings per share, the gearing level, and the control of Melplash. Now, this gives us a real opportunity to get in some of our professional marks as well. So we can be a bit skeptical of the calculations we've done. We can link it to the scenario, so get some commercial acumen marks as well. So remember, this isn't just those 7 marks. We're also then picking up those professional marks as well as a part of this answer, which is great. So let's start with EPS, and we want to start by bringing in the numbers that we calculated in part A. So I've just started off by saying both scenarios give a higher earnings per share figure than the current 0.30, with the cash-based figure giving the highest amount of 0.38. So bringing in some of those numbers. But it's worth then just saying we would be acquiring extra debt and extra finance cost, when there may be insufficient income to actually cover that extra cost. Let's think about some other concerns they may have then. So I've challenged the profit figure. So I said the profit figure used in the calculation, 33 million, may be an above average year for Pymore. So remember, we've valued this whole company based on that earnings figure when we've been using these approaches. We did the value of equity based on that number. So it might be that actually that's slightly misleading, and they may face future pressures as well due to the increased investment required in trains. So again, we're really linking it to the scenario now. And we're seeing that actually, yeah, this could be too high, which would cause us to have overvalued it potentially. Continuing with that skepticism theme, I also questioned the synergy. So the EPS figure is also reliant on the synergy estimate of 8 million being accurate. And the fact that Pymore operates in a different region and different business. Remember, they're more trains, whereas Melplash historically have been more buses. This figure may be difficult to achieve and overly optimistic. So just showing a bit of skepticism there as well. Now, there are more things you could say there. So we could talk about the other factors that could impact this as well. So maybe people stop using trains and actually start using cars more, or environmental pressures. But given the fact it's only 7 marks, I'm going to move on now to the gearing part. So again, we'll start by talking about the impact of gearing, and both possibilities do result in an increase in gearing from Melplash's current 26.5%. But it's worth just saying we could then actually use some surplus cash if we do a share offer and they're all taken up. Maybe we could look to pay off some of Pymore's debt. So we didn't assume that when we did it, but in reality, that could have happened. Then we can talk about the cash offer. So if we were to do that, they'd be likely very worried about the large increase in gearing. It would go up to 45.2%. So again, bringing in my numbers that we worked out earlier, and that would be well above the industry average of 34%. Now remember, high gearing is high risk, so that would be quite risky, and therefore it would likely increase the cost of equity. So they'd start wanting higher returns if the company starts being higher risk. And they're also likely to be concerned about Pymore's existing debt. So would any of that become repayable, or would it be renewed soon, and how that's going to be repaid? So there are a few other things they would be concerned about. Again, there are other things we could talk about here. I'm going to move on just because it's only 7 marks and you don't have all that much time, but lots of other things we could have talked about in there. So maybe how they're going to finance the investment in trains longer term, what we're going to do with that. Are we going to need more debt later down the line as well? So that could impact our decision. For now, let's move on to control. So let's think about the impact of each decision on control. And the first thing to say is if they do the share offer, then they're going to have to share the business with Pymore going forwards. So 1/3 of Melplash's shares would be owned by Pymore. Remember, we said we'd issue them 100 million and Melplash have 200 million. So that is going to be a fairly significant amount of the business that they own. And specifically, we've got the Tullums, haven't we? So they would hold 15% of the business if the share offer is fully token up. So that is going to be higher than any other individual investor currently holds. So that is potentially a concern as well. They're going to have a big say in what's going on in the business. Especially, as we just said here, if they are appointed to senior management roles. So there is a real concern around that. So there you go. A few things that we could talk about in there. It was a maximum of 7 marks for that section. And it was 2 to 3 marks for each bit. So 2 to 3 for EPS, 2 to 3 for your gearing, and then 2 to 3 for your control as well. So get some sensible points down under each, Remember, relate it to the scenario. Can you see how often I'm bringing in numbers, making it really bespoke, talking about the company a lot, talking about their current gearing, talking about trains, the situation, the Tullums. So there's nothing generic in there, is there? It's not like I'm just talking generically about gearing and control. It's all really related to the company, which is great. And finally, part C, discuss the regulatory and governance concerns relating to the promises required by Peter and Patrick Tullum. Now, what are those promises? This was actually in the first exhibit, when they said that I've highlighted there, they would consider accepting a share offer provided they were promised executive directorships on the combined company's board with a package at least equivalent to what they were currently receiving and service contracts for 3 years. So that's what we need to discuss in here. So let's think about it from a regulatory point of view. And we can start by saying any offers made to the brothers would have to fulfill regulatory requirements in Wesnia. Remember, reference the country that we're operating in. So that could be some transparency. So maybe some disclosure of any offer they've received, and then maybe not being involved in discussions. Although that might be quite tricky given the fact that they are on Piemor's board. And then another key part of takeover regulation is the equal treatment of shareholders in general. So if we did say to them they can become directors, that may be additional consideration for their shares. So that wouldn't be fair. So we've got to be very careful about that as well. So a couple of points we can mention around regulation. And then moving on to governance. So we could talk about the Piemor shareholders maybe seeing a bit of a conflict between the Tullum's personal interests and them acting on the interest of Piemor themselves. So Melplash's shareholders may also be concerned about whether they're pulling their weight, essentially. Do they feel that Piemor have performed worse than Melplash, generating earnings and achieving customer satisfaction? So could be a bit of a conflict there. And also there could be a bit of an issue if it seems that the Tullums have been given more generous terms than Melplash's other directors, or maybe more than they deserve. So a 3-year service contract, for example, is longer than is often recommended by governance reports. So we could bring that in as well. So I've made 4 points in there. It was 4 marks, so that's looking pretty good. Again, there are other things we could have talked about. So you could be talking about communication with shareholders. So maybe communicating that, and especially around remuneration and things. So there are a few other things we could have said. But again, for 4 marks, we're looking for around about 4 paragraphs. That's looking great. All right, that's it for this question, Melplash. 25 marks we've earned there, which is great. Lots of discussion parts. Remember to lay those out really neatly and answer exactly what they want. Use subheadings like I did in this question to break up your answer, make it easier to mark, and also make sure you're covering exactly what they've asked. With the calculations, look at how I did those. Again, how to structure them, how to use that information from the scenario to get your answers. Also, make sure you think about those 5 professional marks. So we had the marks for analysis and evaluation, which was using the correct data and coming up with some conclusions. We then also had skepticism. So we were questioning what we were doing and some of the assumptions we were making. And then we had commercial acumen. So making points that were relevant to the company and also were realistic given their circumstances. So we embedded those throughout the question in order to pick up those marks. So well done, 25 marks, great work. Thanks for watching.